So three things going on today that are driving Apple's outperformance. One is $90 billion of free cash flow next year and more cash than debt on their balance sheet, which means as other companies get cheaper, Apple can buy them cheaper. So they end up gaining competitive advantage. Secondly, the biggest criticism of Apple for the last 5 years is no new products. When you look at the product pipeline, lots of excitement there, especially in the press today about how they're going to introduce AR, augmented reality glasses at the next WWDC in June. Autos, electric autos, self-driving cars, lots of new product innovation coming back to Apple now that they've brought silicon in-house, their chip design in-house. And then third, lots of really good numbers coming out of retail about how the products are selling, tablets, especially the high-end iPhones, all of which says that they're going to have high margins and high revenue for the fourth quarter of this year.
Two other names in your coverage universe, Laura, Amazon and Google, are not doing as well as Apple. And I'm wondering if, in a rising interest rate environment, if you think these two names actually don't do well on a relative basis. Is that the truth? Is what the market is telling us the real message?
So we have a confluence of the omicron uncertainty, and that's really bad for Google because 15% of its advertising used to be travel. Mm-hmm. So if travel doesn't come back or autos don't come back, which used to be 25% of total advertising sales, it's bad for Google. So that's correcting a little bit today. And then Amazon just has a lot of debt. So interest rates going up means all your debt costs are greater. All my ad-driven stuff is down today hard. It's 3, 4, 5%. And that's because if you have to pay more for interest expense, you often cut advertising spending so that you can report growing earnings per share to Wall Street.
In your coverage universe, Laura, there are some names that are, in fact, higher valuation. I'm wondering which names are you most concerned about? What names are you telling clients, you know what, this kind of environment may not be the best for these stocks?
Right. So I sort of think we have to learn more about the virus, but I would say if you have a point of view that the virus is going to keep it all at home, you're going to like Netflix and these streamies a little better because you're going to get more uses, especially for ad-driven. And then if you think that we're going to go back into the real world, then things like theme parks at Disney will do better because they still have pretty easy comps.
But even aside from Omicron and variants and the fear about lockdowns, just the fear of rising interest rates has really been a driver of the markets and certain higher valuation stocks, Laura. And so I'm wondering if there are, in fact, stocks you think are, in fact, vulnerable to higher interest rates.
Yeah, definitely. Any stock that's losing money, like I have a lot of high growth stocks that lose money, that's bad for them because a lot of the value of those stocks is in the terminal value 10 years from now or 5 years from now. And if they have higher interest rates, guess what's happening to your discount rate? You're discounting all those cash flows for more years at a higher rate. That's bad for valuations of companies that are negative free cash flow.
Can you give us some examples? And I'm wondering also if you've actually changed your view based on what Powell or the Fed has projected when it comes to interest rates.
Right. So I think, again, we're dealing with both the uncertainty of the virus and the Powell stuff today. But so I would say, yeah, like Fubo loses money, down hard today. Roku not making a lot of money, down hard today. And we have a bunch of stocks, especially small cap, where when you start getting sellers, it really moves the stock more than fundamental value would indicate. So I would say those get more hard hit in this environment. And I think there's a flight to quality with companies that are going to still they're going to weather the storm, not go bankrupt and not have financial distress. And that's why we see the FANGs, again, outperforming today. Others, even if they're down a little, they're not down. They're down a third as much as some of the smaller cap companies.
If you've got a longer term horizon, Laura, and can maybe weather this storm of volatility for a bit, I'm wondering if you think that there are some names that are being thrown out on fear that shouldn't be.
Yeah, like Magnite, we like a lot, 100% ad driven. If we don't get another hard COVID lockdown, really like them for the rebound in auto advertising and advertising generally. So would like that one. And some of the other ad tech names that are 100% ad driven.
Okay. Laura, thanks so much for joining us today. Laura Martin of Needham.